I don't think that Carole needs much of an introduction. She's been here a bunch, and so I'm going to let you just take over and run with it.
Okay, good.
Go for it.
Good morning. How's everybody?
Good morning, Carole.
Okay. First of all, happy holidays, because we're coming up to a holiday, no matter which holiday you have, so happy holiday. All right, we're going to start talking a little bit about the economy. I want to talk about some brand new programs that are coming down, especially in regards to lending, because there's a whole bunch of new programs coming at you, not only from the federal government, but from the state. So I want to go through that so you'll understand, and I kind of want to explain why those programs are coming into effect and what the purpose of them are. And then I will talk about the market, all right? We'll talk a little bit about what's different this year from last year and what I think is going to happen as we move forward. So first, let's talk about the economy, because the economy is better than it was. That's a good thing, all right? If you're feeling that it's a little bit better, it is. I don't think we're completely out of this recession yet. I think there's some little weak spots still in there, but I think no matter where you look, things are feeling and getting better. So let's talk about what we think is better. First of all, look at the stock market. The stock market, we were basically almost under 9,000 at the beginning of this year. We actually dipped, and we're almost close to 11,000. When I came down this morning, it had gotten to 10,009. It was dipping a little bit, going back up a little bit, so back and forth, whatever. But when you think about that from where we were a year ago, if you remember, it was at 7,000 on the Dow. So basically from that point, we're probably up 60%. Now we're still down from that 14,000, but people are looking at the stock market feeling better. People are looking at their statements. They're feeling a little bit richer. People are going back into the market. When you look at basically the earnings of companies, they've come out pretty strong and pretty good. Like a lot of that has been downsizing. Productivity is very strong right now, and I think you're going to begin to see on the top line that businesses are going to begin to improve that revenue line, so that's a good thing. And what has come back out there? I mean, look at the financials, which were down to almost nothing. They've sort of been one of the wonders out there now. Technology has been very strong. The biotechs have certainly been strong, and so basically the commodities markets are strong. So I think we have even different sectors now that are beginning to pick up. So the stock market has certainly been a wonderful green shoot. I looked at oil this morning. It was about $82 a barrel. I guess what can I say about that? We don't like to see oil that high, but remember last July it was $147 a barrel. I think now, we're moving into the spring and summer, so it always goes up a little. I think it's probably going to stay in that $75 to $85 range. We don't like it there, but the world basically has to accept it there pretty much the way it is, but it's better than $147 a barrel. So I think they've been able to hold it, sort of moderate it there. The world's sort of adjusting to that. I think when you look at interest rates, let's talk about that, because I think interest rates are one thing now that you're going to begin to see change a bit. Because now when you go back and you look at the 10-year bond, if you go back over the last 6 months, it was actually at 2.2%. This morning, that 10-year bond was pushing towards 4%. Now, that's a tremendous increase over the last 6 months, and yet when you look at mortgage rates, they have stayed very mellow. They've stayed within basically 0.25% of each other, and we've been as low as 4.8, and maybe we're at 5.1, 5.2 on that 4.17 and below. But Mr. Bernanke is going to stop buying mortgage-backed securities at the end of this month. Now, that's why, even though it's gone from 2.2 all the way up to almost 4, interest rates haven't moved much. Now, he said it, and he is going to do it. So I think here's what's going to happen to interest rates. I think they will begin to tick up. I think that's inevitable. I think the 10-year will get to 4%. I think let's hope we can keep it there for a while and it doesn't get to 4.5%. But I think here's what's going to happen to interest rates. They probably will go up 0.5% by year end, and then I think over a year period they'll probably go up about 1%. Now, how does that compare with average? It's still low, because on average we've spent about 7% on mortgage interest rates over the last 35 years. So even if it went up to 5.5%, it's still low. But you're going to hear all these people whine and cry about it, because they're used to seeing it at 4%. Of course, when it was there, they were waiting for it to go to 3% and nobody would do anything. Now that it'll go to 5.5%, they'll have missed it again, just like they missed every good market they have, waiting for it to go down further. And you just want to slap these people. Because you just want to say to them, how much lower do you think it's going to go? I mean, we're giving you free money as it is. I mean, what do you want the government to pay you to own a house? I guess that would be the next step. And then it wouldn't be enough money that they were paying them, because they'd want more. So I think that basically when you're working with these buyers, you need to tell them they have a window, and I think it's going to begin to tick up. So you are going to see some change in that, but I think it's going to be moderate. I think it's going to be slow. It's not going to be instantaneous, but we're going to hear some grumblings about that for sure, all right? Now, I think that when you look at what else is out there, here's the things that I think are going to happen over this year. The market, basically the stock market, we expect some corrections basically along the way, but I think it'll be over 11,000. It could get a little bit choppy as we go through the year, and one of the reasons is the stock market does not like surprises, and they hate uncertainty. And you still have a lot of that in Congress and in Washington. I mean, they just can't seem to get their act together. I mean, we have health care. Nobody understands the bill. Nobody knows what it means. Nobody knows whether it'll stay or it'll go. You have cap and trade. You have an election in November. They're all going to kill each other. You know that out there. Just spend a lot of money, which is probably good for the economy. Not one of them is worth 5 cents. You do know that. No matter what they say, you can't believe it. No matter what they do, they never get anything done. So at the end of the day, I don't know what to tell you except it's dysfunctional. They are a dysfunctional. I think we should do a Stanford study on all of Congress and all the members there. They are totally dysfunctional back there. But anyway, the markets don't like that. So as we get closer to this election and you begin to see what's going to happen, and this group is talking about that group, and they're going to be out, and I'll be in, and blah, 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 blah. You'll probably see some choppiness in the economy as they're going out there, because that's always what the markets don't like. But I think at the end of the day, here's what's going to happen. You're going to have positive growth. Now, you had it last quarter. You're going to have it this quarter. Last quarter, they revised it to about 5.6%. I think when you take out cash for clunkers and first-time home buyers, etc., it's probably closer to net about 2%. I think this quarter you're going to hear it's going to be about 4% too, but I think if you take out everything again and you take out government stimulus and we get down to what the economy by itself is really growing, it's probably about 2%. So we're going to end the year positive. That's a good thing. But it's not going to be this recovery of 4, 5, or 6% growth. I think what you're going to see out there is probably 2.5% growth. I think that basically the stock market will be positive. Oil's going to stay at that range. So I think we're moving in the right direction, all right? I think that basically we're coming out of this. We'll probably be out of this recession probably by the end of the year, early first quarter next year. Now, what are the things that are going to keep it a mild recovery? Obviously, you still have unemployment. Now, you know, we still lost 36,000 jobs last month. We lost 85,000 the month before. The number is coming out this Friday, the big number. Now, here's what I think. I think we could get close to almost break even, all right? I think if it's not, it's going to be a surprise. That will jolt the markets. I don't know that it's going to be positive. Even if it is, I would question that because of the census hiring, because that's going to add 100,000 people to the roles that ordinarily wouldn't be there. I don't believe the 9.7% number, because if you add everybody in, we're probably closer to about 17% unemployment. So you know that even if we had a positive number, it's not going to bring that 9.7% down a lot. That's going to take time. So if we have to go from 17 down to -5, which is full employment, it's a year, 2, 3 years out there, because we have to see them start adding about 250,000 positive jobs a month. And I don't see that happening right now. Businesses, until they know what this tax situation is going to be, what the cap and trade and the health care means, they're not just running out there to hire people. So I think that's one thing that's going to keep it mild. The deficit, obviously, we have one. You know, they keep telling us that, oh, there it's there, and yeah, maybe it means something. Well, it's 1.6 trillion this year. They raised the ceiling on the debt. You know, they had an auction last week. That auction was a little bit tough on us. A lot of people didn't want to come in and buy it because I think they're going to have to see higher interest rates in order to basically make them want to come in and keep buying our debt. I don't think they'll stop buying it, but I think the terms, conditions, and what we're going to have to pay for it keeps getting higher and more difficult as we keep basically leveraging more of our life away and we keep increasing this deficit. Now, are they ever going to address it? I guess somebody sometime will. They don't seem like they're ready to address it. I don't know. They come up with 2 and 2 is 65. I don't know how they do that, but they manage to do it. When I went to school, 2 and 2 was 4. I don't know how you get to 65, but I guess it depends whether you're an accountant, an economist, or a politician. Because if you're an accountant, it's 4. If you're an economist, you can make it be 6. But if you're a politician, it can be 65. So I guess those are the definitions of how you get the different numbers. So I think that basically, as far as the economy is concerned, it's better as we go. Here's the bigger picture, I think. I think beyond a recession, what's really happening in the economies of the world, if you go back and you look, we've had a really rough decade, all right? We have had a lot of bursts and a lot of bubbles and a lot of highs and a lot of lows. Because let's go back to the year 2000. We're used to having recessions. We have always had those. We used to have them every 4 years. Now they've moved them so that they happen about every 8 years, all right? But look what happened this decade. We started with Y2K, if you remember, and everybody spent $1 gazillion trillion to make sure that all these computers wouldn't go off and the whole world wouldn't tilt. Well, I think it did. Nobody told us that's how we got here, but they didn't tell us that, all right? But then, you know, we moved into a recession because there was a tech blow-up, if you remember. And in order to keep us in this mild recession, they basically allowed people and wanted everybody to get into the housing market, so they moved all of that, and they allowed all these lax rules and underwriting.